We're among the most indebted on earth, and our mortgages are to blame for most of it. Even with interest rates at record lows, it's starting to hurt.
Struggling to pay now, so if it's going to be any worse.
How much did you factor in that rates might go up?
I don't think we really took that into factor, to be honest.
Just one example of the many in Sydney now sitting on a ticking debt bomb.
In some cases, we've now got pretty much every household in a particular postcode in stress, which is not good news.
Martin North's detailed modelling tracks the impact of home loan debt. His latest research shows 2/3 of homes in Edmondson Park and 63% in the Ponds are currently in mortgage stress. If rates were to rise by 0.5%, around 80% of households in those suburbs would be struggling.
People who've bought relatively recently, and that's particularly newly constructed suburbs, will have bought at pretty much the top of the market. They will have got very, very large mortgages. Their income has not grown.
But that debt bomb is Sydney-wide, with more than 50% of households in stress now, stretching from Camden and Liverpool in the southwest up to North Parramatta and Mount Colah, with Fairlight on the northern beaches and Kingsford in the east also affected. The reality is the Reserve Bank isn't likely to lift the official interest rate anytime soon. Most economists believe it'll all stay steady for 12 to 18 months. But that doesn't mean rates aren't going up, because the banks are already lifting them all by themselves. The Bank of Queensland was the latest to lift mortgage rates just today.
What we're seeing is the cost of funding really squeezing the bank's profit margins at the moment. And for some banks, that is too much, and they've hiked rates to recoup some of that money.
Almost certainly, others will follow. EDDY MEYER, 9 News.